Assalamualaikum warahmatullah. Very good morning to everybody. Welcome to Sada Education Society. Today we will be looking at the conception of sale that we have discussed a little bit in our previous video when we look into the issues and challenges of setting up the Islamic banking business within a dual financial system. So, as we know that the foundation of Islamic Bank is based on the prescription of sale as opposed to the use of riba, and therefore the most suitable platform to see whether sale is applicable is the banking business, as this is where riba predominates, as bank mobilize deposit fund as a loan supplied by the depositors at a certain rate of interest, and at the same time the bank uses the deposit funds to make loan, and the bank charges a certain loan rate on those loans. So in a sense that when riba prevail in the banking business, and therefore we would like to see to what extent al-bay' can be applied in banking so as to assist and to facilitate the purchase of homes and motor cars and other financial facilities needed by the consumer. And therefore, since sale has been prescribed by the Quran, and therefore we would like to see in more detail what is a sale and how it can be actually applied in the banking business. As we know that the banking business is a money lending business, whereby we pay interest on the loan that we take from the bank, or the bank pay interest on the deposit they take from the depositors. But then to apply al-bay' or sale under that system of lending and borrowing, this can be a challenging task for Islamic bankers, and let us see how they are able to accommodate the new structure of buy and sell within the banking ecosystem. If we look at the slide here, there are some definition and some description what constitute a sale. I presume that these are quite common to most of us, but then it is worthy to look into them, as we should be able to discover some new issues as well as conception related to al-bay'. Number one, al-bay' or sale involve an exchange of goods for money or for a price. So meaning that a sale is not a money lending activity. It is an exchange of goods or commodity. So in fiqh we call it al-mal mutakawim, meaning that goods that provide manfa'ah or utility to the user, and therefore sale is the exchange of al-mal or property for money or for a price. Okay, number two, sale is the transfer of ownership from the selling party to the buying party. So we can see that when there is a sale, the selling party would transfer the title of the property to the buyer, so that the buyer have the total right to utilize what he have bought from the trader. So this is a very important principle in sale, because so that would be the objective of a sale, which is to ensure that the buyer are able to take over total ownership of the property. Number 3, sale is a real sector transaction, partly. So real sector, we are looking at the production of goods or output based on the combination of inputs, which is labor and capital. And in that case, when we are looking at a real sector transaction, we are referring to the gross domestic product, because one of the measurement of GDP is the output of its output from production. So sale is a real sector production, and therefore in Islamic banking, when we are looking at sale in general, we are referring to through sale, through leasing, and even equity financing, all of which I presume are able to contribute to production and to the GDP. And then sale is carried by entrepreneur. So meaning that we got merchants and are involved in the buying and selling, and therefore sale is entrepreneurship. So when the Quran prescribes al-bay', so it is pro-entrepreneur, and therefore Islamic finance should be more or less focusing on entrepreneurship and business, apart from the current focus on contract that that need to be compliant to the requirement of Sharia. And then we can see that the entrepreneur who is conducting sale, they are basically confronted with what we call ownership risk, because the entrepreneur will use his capital to purchase the goods, and there is no guarantee that he is able to buy or there's no guarantee that he is able to sell at the targeted price, and because he has no control, as prices are set by the market forces, and how much he can sell depends on the market prices. So his capital investment is not guaranteed, and it will be determined by the price that he can fetch in the marketplace. So there is a possibility that his capital investment will appreciate in the case of profit, or it can also depreciate in the case of losses. And therefore, we may have come across the legal maxim, al-gharr bi ghunni, that is, with profit come losses. And this is the law in nature in businesses, that all businesses will have to face risk in order to gain reward. No pain, no gain. This is a very ordinary business principle, and these are what al-bay' has been trying to project to all of us, that in al-bay' we should be aware of this no pay no gain principle, as opposed to riba, where profit is a gain without the taking of profit, without the taking of risk. At the same time, the selling party provide warranties for the sale he made. So if there's a defect in the goods that he sold, then these warranties will remedy the problem, and that will come under the legal maxim of al-kharaj bidaman. And therefore, when we are looking at a sale, the two legal maxim of al-gharr bil ghunni and al-kharaj bidaman are the main foundation or principle that any financial institution should observe in their attempt to apply the concept of sale in their respective businesses. But we can see that when a bank is using a sale, as described here, it can be very risky, because once the bank conduct a sale whereby the bank will initially purchase the goods from the supplier and then will put the goods on their book, which means that the bank will take ownership of the goods and therefore facing ownership risk that is likely to pose danger to the bank, as the value of this asset can decline due to market volatility. And therefore, we will see that doing sale within a banking framework could be very risky and may not be viable at all, because banks are required to hold high amount of capital in order to cushion the exposure against losses. So ownership risk in banking will trigger high capital charges, and therefore bank may not be able to see the use of al-bay' as a viable modality, and therefore we should further look into this these so-called challenges that the bank is currently facing when they attempt to use sale in their business model. We can see that, for example, in the central bank guideline on capital adequacy, that if the bank conduct what we call a murabaha by purchase order, or MPO, whereby the bank will buy the goods intended for resale, the capital charges, are extremely high, which is, by using the basic indicator approach, it is 15% of the value of the exposure, 50%, or 187% if we are using the credit risk weighting system. So therefore, it is quite a challenge if the bank wishes to use the murabaha by purchase order object financing. But this is again a challenge when the funding is coming from deposit. So meaning that if the bank uses a deposit fund to do the object finance or to do the MPO, then the capital accorded to that transaction will be extremely high, because we are using a deposit fund where risk in deposit is zero. However, if we were to use the investment account fund to finance the MPO, then the capital charges would diminish, because the risks associated with the MPO will now be carried by the investment account holder. So this is a very interesting subject. I do hope that later on we can get into this discussion of investment account, to further see how al-bay' can be totally or successfully applied in the Islamic banking business today. So I think that is for today. Inshallah, we'll come back in another video looking at the challenges of using sale in the Islamic bank. Thank you very much. Assalamualaikum warahmatullah.